Hello, good afternoon. Let's check in with the market. You guys saw my interview with Howard. I appreciate you all for being there. I thought it was a good interview. I thought it went well. All right. Well, look at this. Another day, another all-time record. ES up. Looks like it closed on an all-time high. Same thing with the NASDAQ. Bitcoin down more than 2%. What is going on, Bitcoin? What is going on, Bitcoin? Jackson, what are you doing? Why do you have your food bowl? Jackson, you don't need any more food. Just give it a break. Look at AMD. AMD making a nice 3-bar reversal, kind of a 4-bar reversal, whatever. Amazon. Jackson, what did you do with there, buddy? But look at ARK. ARK is incredible. Has multiple bullish open gaps underneath it, one right here and one right here that's still open from a few days ago. Probably there's one back here that's still open. 62 area. There's probably, it looks like, I bet there's another couple that I can't even see here. Anyway, it's a bullish chart. Coinbase. Having problems with the 330 through 360 area. Just left some overhead supply. Anyway, hopefully they'll chew their way through those orders and be back to all-time highs soon. GameStop looks good lately, especially on the daily chart. Google's been a monster lately. All right, so that's awesome. Let's look at some other stuff. Let's look at the crypto quartet. All right, look at old LFGY up 60 basis points. I like to see that. I don't know why it's not showing the average. What's going on with the average? Oh, I think I know why. All right, so still it ought to be showing the average, but it's fine, whatever. So Bitmine immersion, what are you doing, Tom Lee? Why are you going around pumping this damn thing? Down 10%. Anyway, LFGY is none the worse for wear. They're absolutely killing it. Hut's up big. BitDeer's up 9%. BitDoor, whatever it is. NVIDIA's even up 3.97%. All right, well, nice job, LFGY. I like to see that. Let's look at Salty. Yep, Salty's down. Boy, more than 1%, 1.17. Wow. Salty's taking it on the chin. Salty short Bitmine immersion. How are you down when you're short something? I mean, that's, you think that alone would make them up a bunch. Of course, they're capped out on the upside, on the downside, or capped out, but fully capped because they're doing callers, or in this case, reverse callers. Anyway, APLD's up 20%, so that's not helping Salty's cause. BitDeer's down 9%, Bitmine immersion's down 7%, so that's certainly helping out. They've got some winners here. GitLab, Lemonade. I mean, that's a big winner. Lemonade's down 7.2. Really? I mean, they've got some big winners. What are they doing here? It shows Lemonade's only down 2. Yeah, okay. Oh, the weighting was 7%. Okay, yeah, it's down 2%. That's still a lot to be down, though. All right. Restoration Hardware is down 3%. Anyway, well, I don't know what Salty's deal is. Not doing a very good job lately. Not doing a good job generating alpha. Let's look at blocks. Well, blocks is down a little bit, less than a point though. It has some good. I mean, Galaxy's up 2.4%, and 5% of the portfolios in Galaxy, 5% of the portfolios in HUT, and that's up 4%. 4% of the portfolios in IRID, and that's up huge. Did anyone get this? Is CIFR? Is that? Let's look at that. Cipher mining. I was telling people about that to get that, and I'm not because I knew anything. Because when I saw they added it into Alti, and into some other ones. Anyway, well, that's looking good. Hey, Marcus, how you doing? All right, so it's back to the crypto quartet. Anyway, blocks, yeah, not doing great. Howard from Curve sounded like he was a little bit bearish. Anyway, all right, so that's blocks. So what else do we have to check? LFGY, have we checked Alti? I don't believe we have checked Alti yet. What's Open doing that being down 12%? Come on. SMR's down. Not a very good day for Alti. Let's look at Alti over here. Well, another all-time high, though. All right. All right, the crypto quartet. Let's look at the index buffer report. The index buffer report. Look at old Y-Spy outperforming. That's good to see. Q up is up 1.5. That's nice to see. Up about as much as the triple leverage Qs, which is kind of pretty much what it is. K triple Q from Curve beating its benchmark. SEPI beating the benchmark. And YMAG beating the benchmark. Underperforming are Salty, ZVol, VYLD. We haven't really talked about that one much. That's from VYLD is from, I don't remember who that's from. VYLD. Inverse VIX, short-term futures. Well, it's inverse VIX, so it's bullish. Yeah, so when VIX is down, this thing goes up, and you can see here, I forgot. I really don't know much about this. I forgot what the deal was with this fund, how they did it, or whatever. But that's pretty good looking right there. This is maybe the hope was it was going to be the new S-Fall or something. Was that the hope? I'm trying to think. S-Fall's just kind of been crazy, but let's look here. BYLD, let's see what this is. Inverse fixed short-term futures. What company is it from? JP Morgan Chase. No. 10% for the quarter. Doesn't pay a yield, but it's up 10% for the quarter. I mean, 10% for the quarter is not bad. Anyway, back to the index buffer report. I really don't see anything else that looks that interesting. Look how SPY-T got all that upside, all the parents upside, a little bit more than all the upside. You got to like that. Yield max buffer report. Here we go. The yield max buffer report. ABDI outperforming on the way down. It was this morning also. Dizzo's outperforming. And MSFO's outperforming on the way down. But on the way up, YMAG is outperforming. Great job, YMAG. YMAX is coming close to outperforming, but not quite. All right, so now let's go over here to the new Max Factorage. All right, and so we're over here at the new Max Factory. Let's go to the main database and maybe sort it by short term. In any event, or we looked at the short term earlier. Maybe we'll look at the long term right now. Is Alti really number one? Oh, it's not. Okay, Alti's not number one on the long term. Alti's number one on the Moxie factor. On long term, let me do it this way. On long term, number one is Goop. Think about this thing. It was at 24 90 days ago. It's at 33 now. It was at 28 360 days ago. It's at 33 now. It has a 20 volatility, so it's about twice as risky as the market as a whole. 1 year total return of 36.8% with a 17% yield that was distributable because it's able to pay that 17% yield. It had a 36% total return. So that means the NAV return would have been positive, total return positive, yield positive. This is the full package. There's Maxi. Same thing with Maxi. Maxi paying a yield of 32%. It's distributable because the total return was 64%. Maxi's been killing it. Then we have Misty down here. Now, Misty 90 days ago was at 21, and it's, at 1586 today. But of course, it pays a pretty decent yield there, so you can do that to some extent. It's a 45 on volatility. It's one of the more volatile, but has a 1 year total return of 62%. Then we have YBTC and GUI, TSLI, Snowy, GDXY, Babo, TSLP, Silvo, OARC, Infly, KQQ, YETH, TSMY, YBIT, NFLP. Look how many that Howard from Curve has in the top 20. And this is the long-term top 20. All right, so he has Goop, right? Goop's Curve, right? I mean, of course it's curved. Okay, Goop's curved. So he has one. Then he has TSLP is curved. Then he has KQQQ, and then he has one more, NFLP. And those are good ones. I mean, you heard him on the show. They maximize. They try to maximize. He had a different way of calling it. I would call it distributable income, but income which you're able to distribute without cannibalizing the investment or without cannibalizing it too much. All right, let's go back over the main database. Well, the main database is still loading, so that's fine. Max's Moxie rating, there it is. Alti's back at number 1. Then weak, then USOI, then WDTE, then triple QI, then IWMY, then TSYY, then GLDY, then YMAX, then HYGW, then MISTI, then XDTE, then QDT. Those are all good ETFs in my opinion. All right, so look what I found. Defiance, I found their trades. They published the trades. Right here. See this QLDY? They sold the, I can't believe we're already at 24. They sold the 24 570s and they bought the 24 450s. 570 450s. That's like 120 NASDAQ points apart. They did 120 wide point spread. This is how they're going to pay you twice a week. See that $91? They brought that in because they sold that short. But then they bought, they spent about $40. So it's going to make about $50. So we could figure that out. So it's $50 times 100 is 5,000. They just did one of those contracts. Look at that. But yeah, because they're small. So what's 5,000 times 200? Is it, it's 100,000, right? I'm trying to figure out what the payment's going to be, if they could do that every day. Anyway, I'll figure it out. So that's the trade for Friday. So I'm going to start following the daily trades. The Monday's trade hasn't been posted yet. This is Friday's trade. So I guess I'll start having AI follow the daily trades, and because this should be pretty easy. We could look at the lightning spread and see how much it should pay. I mean, it should be easy. We just got to keep track of how much it makes every day. Is that right? So it's going to make 100,000. So if it made 5,000 a day, yeah. All right. All right. So what else? Anything you guys want to talk about? We can sort of talk about it. Yeah. QLD's Thursday and Monday. Okay. I hadn't heard about that. According to their website, should start next week. Okay. Well, we're going to watch every freaking trade. I mean, I think it just came out Thursday, right? So it's been out one day, Friday. So I have Fridays downloaded, and now I have Mondays download. Well, I'll download Mondays, and yeah. So it's okay. That's right. It was 5,000 times. Okay, yeah. It was $5,000 off that one option, but there's 220 days in a year. So 5,000 times, and I just made it 200 to make it easier. So that's 1 million is 5,000. Okay. So what's the notional value of that, of one contract? So let's look into that. The notional value, because we can look at their position. They have 1,000 strike. They have 1,000 strike calls. So notionally, if it's trading at 24,000, so they have something that costs 23,000. So that's 2.3 million. Okay, and they got 100 million or a million worth of income off something that costs 2.3. If they could repeat that every day, that's exactly what I was trying to figure out. So that's the answer right there. If they make that much every day, and it was just one day, so I mean we'll get a better average as they go along and do multiple days. But if they make that much every day, they would make $1 million on a 2 point. That synthetic costs $2.4 million down. It's just the cost of the index. So I'm trying to think what that would be. I guess about 40%, something like that. And they pay it twice a week. I mean, just based on that one day, but we're going to start tracking it here. So stick around. But yeah, thanks for that. I could not think for some reason. But of course, $5,000 times 200, because 5,000 times 2 is 10,000. So times 20 is 100,000. So times 200, is $1 million. Anyway, but that would make sense because it's a $2.4 million investment. You make about $1 million. You make about a quarter. Something like that. Anyway, but I'm looking forward to see how that goes. Boy, there's only 3 of us here today. That usually these live streams are more popular. For whatever reason, everyone's busy today. I wonder if Rod's doing a live stream or something. One time I did a live stream on here and I couldn't understand why no one was here, and I signed off and Rod was on one. Anyway, it's fine. I don't do these for the money. I don't do any of this for money. Looks like maybe that 40 or 50% you mentioned. Yeah, just based on that quick math. I mean, it's a 50-point. It was a 50-point spread. Each point's worth $100. So that's 5,000 multiplied by 220 days in a year, not just 200. So it's really more like 1.1 million. And it ties up about 2.4 million. So yeah, it's about 40%. It's about 40%. So I mean, based on that one day, but we'll watch it. We'll watch it every day and figure it out. But yeah, curve's a different deal because it's actually their goal to outperform. Where most people will tell you, hell, we don't know what the market's going to do. It's not our goal to outperform. It's our goal to pay a yield. And that's fine too, because paying a yield, that can work in portfolios. You need a yield for retirement. You can mix in some, that works too. But these guys are like, these guys are different. They're trying to actually make money, make like total return, not just make yield. So it's a different philosophy. But anyway, I really enjoyed talking with Howard, and thanks for listening. I appreciate you guys for listening. But now I'm looking forward to tracking QLDY. No one else is really tracking it. I don't think people understand the lightning spread. QLDY has a concept out there that I'm calling distributable income. I made like an hour-long video that's recorded, and I just never did release it. I cut it down to 30 minutes. But I get into the back tester and talk about the concept of distributable income. But it's the same thing Howard was calling good income in his thing today. But I'm just calling it distributable income. But it's like, anyway, hopefully I'll release that other video soon. I don't know. I just wanted to do this Howard interview and do a good job on that. So right now at this point, the ETFs that cover the bases are Curve and Rex shares. So Rex shares is good. Rex shares is good. But here's the other thing. So those are, if somebody said, okay, you can have a high yield portfolio, you can have a high yield ETF, but you can only have one, then yeah, I might take KQQQ. I mean, but if you could only have one, and that had to be your growth assets too, or something like that. But I don't have a problem having VU and tons of growth assets and mixing in ones that I know are going to underperform or that I don't expect to outperform just to get a little bit of yield. I don't know that the fund outperforming on its own is that big of a deal, but I could see the beauty in it too. I can definitely see the beauty in it too. But I think that's kind of the wave of the future. I think that's what this video I made yesterday was about. Kind of the first generation covered calls, the income, it generated income, but it wasn't distributable income. You could distribute it, but at the peril of the NAV and or of the total return or of some combination of them both. But that's no longer the thing. We see it with blocks. We see it with KQQQ. There's funds out there that are able to generate income where it's true alpha. They're paying a yield, but then also, and then not giving up anything, then also performing as well as the parent, if not better. So, I think that's the new thing. It's all going to be about distributable income in the future. You need these funds that make good distributable income. A great place to start on distributable income is Defiance. That QILD, that the lightning spread is designed, in my opinion, to give you distributable income. Because think, if it could pay 40%, it's built for a bull market too, but it pays 40%. And then in the market where we mostly go up, because they're selling put spreads, they don't have to settle many losing trades. So they make the 40% or whatever, and they are able to pay that to you, but they get pretty much the same upside as whatever the market has. That's distributable income. And that's what I think the lightning spread. I'm hoping, like I said, I could care less about the twice a week. It doesn't matter if I pay twice a week, but I just wanted, I'm looking for something that outperforms. I'll be interested to put QILD against KQQQ. Now, Howard's doing it not mechanically. Howard's doing it with judgment. Selling calls and stocks he thinks are not, I'm interested more in the mechanical, just doing a systematic type thing, or that's more what I like. That's what that's what the lightning spread is. QILD is just mechanical, but I think that it's designed to give more distributable income in the same way Howard runs his fund in a discretionary way, in a way to get more more alpha or whatever. Yeah. So if it can hold its NAV, that's the eternal question. Well, it can hold its NAV as long as the market goes up. Yeah, these lightning spreads are super bullish because they're selling put spreads. So they're kind of like double bullish. It's just kind of like an XO. As long as the market's good, just look at blocks. Blocks does the same option strategy that QILD is doing. But anyway, I'm with you though. I'm with you. If they can hold its NAV, I'm going to get some anyway because I like what it's going to do. But yeah, this should, I think everyone will buy a ton if it can hold its NAV, if it can actually be distributable income like KQQQ in the way that it can make a yield, but the yield doesn't impede the ability for the fund's assets to grow. That's what I was trying to say. That's all I was trying to say. Well, anyway, there's 6 of you guys here now, but that's fine. Also, I started this a little bit late. I'll just let you guys get out of here. I appreciate you all for being here. Are they doing any puts on? No. Lightning spreads, they're doing puts, but what they do is they sell a put spread. So I don't think they're doing defensive puts, if that's what you mean. Selling a put spread is really offensive. Selling a put spread is basically a covered call. All the lightning spread is they're doing a covered call at the same time they own stock, but they aren't doing the covered call on stock they own. They're doing a covered call on stock they don't own, and then they own stock that's from a different pile of stock. It's just like cheating. The lightning spread, selling puts on something you already own. You're just kind of double down. You're double long between the two strikes. It's poor man's leverage, something like that. So, it's the same thing it's just kind of double dipping, but it's a great strategy. So yeah, but because it's double dipping, it's double dependent on the market to go up. But because in the opposite way of a fund that does call spreads, a fund that does call spreads, it has a good, when the market goes up, it loses on the call spread, but it wins. So it has a good news, bad news situation, kind of an offset. But in a lightning spread, the market goes up, it just goes up, and it wins on the call spread. There's no bad news. It's just good news that the market goes up. So the lightning spread is just a way of leveraging long, but it's a unique. It's cool though, because you can be long and without impeding your upside. But it's just a lightning spread. It's just another covered call. Put spreads are just covered calls. They're bullish. A sold put spread's a synthetic collar. A sold put is a synthetic covered call, and a sold put spread is a synthetic collar. So all these funds are basically doing the same thing because they're just doing collars. The only thing that's different is there's other funds that are selling put spreads. Granite Shares is selling put spreads, but they aren't selling put spreads on something they already own. That's what the lightning spread is. The lightning spread is, hell, I'm going to sell put spreads on something that I already own. Granite Shares is a good strategy too. They're just selling put spreads. They're just selling put spreads by themselves. So they're just doing a collar. For these funds that are doing a lightning spread, it's like they're doing a collar at the same time they own stock and they aren't attached to each other. So they're long a collar and they're long stock at the same time. So they're just sneaking in a little extra long action. So on down days that QLDY should eat it. Yeah, exactly. It's the opposite of a covered call strategy. They both make a yield, but it makes it kind of the opposite way. A covered call makes extra money on a down day. So that's why those funds have buffer, because a covered call, you lose on your stock on a down day, but oh, good, I sold that option and it expired worthless. So I offset it a little bit. That's the old way of making an income. That's the good news. The bad news was on an up day, you're like, oh, darn, I cost myself some upside. Okay. Well, the new way of doing it, you still own stock. You own the stock or the synthetic, and then you sell a put or a put spread. So yeah, then on a down day, you're down because you own the stock. Okay, that sucks. I'm down because I own the stock, just like in the covered call. And I have to settle the put spread for a losing amount of money. And so instead of a buffer, you have negative buffer. And in fact, you get a little bit, the lightning spread, you're going to get an acceleration to the downside. That's what I'm saying. They're just extra bullish. They're built for speed. But you'll get a little, you'll get negative buffer. Instead of a buffer, you'll pay a toll on the way down. But the trade-off is on the way up, there is no toll. You won't get any, no buffering on the way up. The problem with regular covered calls are they buffer both ways. You get a little bit less downside, but you get less upside. The less upside is what the key is, though, because that keeps you from outperforming the market. Well, so on the new strategies, the less upside is no longer a deal. You can get just as much upside. So, that's what Howard's doing. And that's what the lightning spread's trying to do. But they're new. We'll see. I'm excited about them, but I'm going to follow them every day. Thursdays and Mondays for the paydays. So I wonder the first payday will probably be this Thursday. So they came out last Thursday. Or I wonder if they paid this Monday. I mean, probably not. They'll probably wait a while, but it should be easy to figure out what they're paying because they aren't going to trade options. They're just going to sell a spread every day. All we have to do is figure out how much the spread is worth, what they sold it for, add it up and divide it by the assets, and we'll know exactly what they're doing. We'll estimate that. We'll estimate that one. I wonder when X dividend day is. They probably have 2 X's. They probably go X, Wednesday and Friday or something. Okay, good information, Marcus. Next Thursday's the day. First payday will be October 2nd. Okay, well, so they'll get a week ahead. That's a good way to do it, too. They'll get a week ahead. That's a good way to do it. Yeah, those lightning spreads are interesting. The first thing I said when Jay told me about it, I just said, so you're double long. And he said, yeah, but just between the strikes, but it's just a way to get more long. So it's bullish, definitely bullish. All right, guys, I'm going to get out of here. I appreciate you all for being here. There's 9 of you here. It got started kind of slow, but we got moving a little bit better. I would show something else if I had it to show. But we've already looked at the max factor. We've looked at, we haven't, I haven't, we could look at the newest max factor rankings they just got in. Or, well, actually, no, some of them are still loading. We'll just do that. We did max factor. Good enough. We've already done max factor. All right, guys. You guys have a great day. Oh, the goat spread. Yeah, we could talk about that sometime. The goat spread just modified. I thought I discovered it, but it wasn't that profitable once I forget what it was, but I thought I discovered saying it wasn't that profitable. But the new goat spread is just a lightning spread. The new goat spread is long synthetic and selling at 20 delta put and buying at 10 delta put. That gets you just a little bit of income that's distributable, and you're still long through the synthetic. That's my newest trade that's testing out the best. Basically the same thing QLDY is doing, but the lightning is just changed into the goat. The goat is the lightning, and the lightning's the goat. So anyway, all right, guys. Well, I appreciate y'all for being here, and I will talk to you later.